actually, in the short term, the market is expected to be quite volatile. As we can see from year to date, we had ups, very strong ups, and some reasons down, and then stabilizations on Friday. And in fact, this type of market volatility is not unexpected for this year because we had very strong market last year, and this year we expect the market to focus on growth recovery, growth restoration, and that actually something that the market will price in further. But in the interim, because market valuations have become quite expensive before the sell-off, so I would describe this as a healthy corrections over the longer term. But for the over the rest of the year, we expect the fundamental to remain solid and focus on growth, and there is no need for any significant macro tightening, and the policy will continue to be accommodative. Yeah.
Cecilia, good morning. Tanvi joining in this conversation. Warren Buffett is saying in his letter to shareholders that bonds are not the place to be these days. They face a bleak future. As a chief investment officer, do you think that's true, that this asset class has lost its mojo?
Well, I think interesting. Well, when we talk about bonds, we do need to separate government bonds and credit bonds. Say for government bonds, as we can see in most of the the major global government bonds, like in Europe, in Japan, we got negative rates. So I mean, say it's a bit, well, of course, it's unusual, it's a abnormal situation, and but for say in US, even like, well, it's zero interest rate, and then that is not the long-term normal or equilibrium level. So yeah, moving forward, we expect some normalization over very long term. But however, in the coming year, it's too soon to say to mention about any tightening. So I think in the short term, it's still like a stable, or is the rate will continue to stay in a narrow range. I would think, despite some steepening in yield curve in U.S. Treasury expected. But however, if you look at it from the yield carry angle, I mean, it's true that government bonds is an area that is not that interesting. And in fact, in our global portfolio, we've been underweighting government bonds. But however, credit bond has got a different story, because if you expect the monetary policy to be accommodative, and at the same time, for credit spread, we still offer yield pickup against cash, and it is a good risk reward asset class, and especially for Asia, the Asian credit spread has offered some yield premium over global credit. So we continue to see the good relative value in Asian credit. But however, I mean, we're not looking or expecting for big capital appreciation this year. We are looking at it more as a yield carry type of opportunities.